All right, let's do it. So, Mitchell, first introduce yourself. Why should people trust you? And uh, who do you work with? And tell us about your firm.
Yeah, welcome to the webinar. My name is Mitchell Baldridge. I'm a CPA and a financial planner. We have a firm called Baldridge Financial. We work with real estate syndicators who buy, fix up, rent out, maintain, sell big properties in all asset classes, so apartments and warehouses and storage and all kinds of stuff. And so we are experts in understanding operating agreements, understanding taxes, and beyond just preparing people's tax returns, helping people develop tax strategies around real estate, which is pretty much the cheat code to taxes out there today.
I love it, man. So let me see if I can get this slideshow to work. I'm going to share. We're not going to spend the whole time in this document, but this is what we're going to talk about today. We're going to talk about bonus depreciation, how you can get chunks of tax deductions early on in ownership of a real estate asset. We're going to talk about what it means to be a real estate professional. We're going to talk about a short-term rental. STR stands for short-term rental. We're going to talk about a workaround with RE Pro status and STRs. We're going to talk about recapture, what happens if you sell an asset. We're going to talk about 1031 exchanges, how they work. We're going to talk about stepping up basis if you die, when you die, and we're going to talk about opportunity zones and a couple other real estate tax saving opportunities. But I think it's fair to say that the government wants to incentivize folks to own real estate. And they do so by giving us a pretty advantageous tax code that allows us to benefit from a tax perspective when we do own and buy real estate. So let's talk about depreciation, how it works. So the way I like to do this is I'm just a layman. I'm just a guy. I buy real estate. I'm not very smart. So I'm going to explain it as simply as possible in non-tax language. And then I want you, Mitchell, to elaborate and correct me wherever I'm wrong. How's that sound?
Perfect.
Okay, so depreciation, if you run a company and you buy something, generally you deduct it year one. If I buy this mouse, I buy a computer, I just write it off. That year it's a deduction, it's a cost. But a building is different. This building that I'm in, it's a house, it has windows, it has floors, it has doors. The government says I can't deduct it all in year one. This is a residential building. I can deduct it over 27 and a half years. Or every year, 3.63% of the value of the property I can deduct against my taxes. Commercial real estate's 39 years, 2.53% of the value. And let's go through an example. Let's say I buy a $1 million commercial building, divided by 39 years. That's $25,600 every year that I get to deduct against my taxes, ongoing to offset my income, basically. That's a pretty good bonus because when you're buying a $1 million building, you expect maybe $60,000, $70,000 of taxable income from it. So a pretty big chunk written off. Yeah, anything I'm missing here? If it generates $60,000 of net operating income, 42% of my net operating income is shielded from this, what we call straight line depreciation.
Yeah. So, I mean, again, you take that like stapler, which is just kind of any asset that you buy under $2,500 hits this safe harbor. So whether it's a MacBook Pro or a stapler or, a Rima paper, these are all considered
Or
consumable
wages, like
items.
labor wages. Yeah, all
Well,
of it.
labor, yeah, and labor is generally expensed anyway, but I'm talking about things that you're going to hold around your office for the next
Yep.
40 years. I mean, you walk into one of those dusty old offices with a 60-year-old stapler, they wrote that off the year they bought it, even though they're going to own it for forever. But when you get into to expenses or expenditures, I should say, that are above $2,500, like real estate or like a
Car.
Ford F-150, yeah, you start to get into this is a capital asset. This is going to have to be consumed over time based on the tax code, whether that's 5 years, 7 years, 15 years, or, in
Useful
the,
life, basically. The government tells us how long the useful life is, and we can deduct a percentage of it every single
and
year.
so even the status quo of real estate, if you buy a $1 million building and you get to deduct 25 grand a year, That's why they say real estate is the best business in the world, because you just sit there and you chew up your net operating income, and you can go borrow money against it tax free, and you can hold it forever and step it up. But then we're going to get into, bonus depreciation, which really
Yeah, imagine if
steps
you
this
worked
up.
to imagine how much more money you'd be able to keep over a career if 42% of your W-2 income was shielded from taxes.
That's pretty good.
That's just straight line depreciation. That's one of the really powerful parts of this, but it goes a step further. So the government says this home I'm in has a 27-year lifespan, but there's a lot of parts of it that have a quicker depreciation span and a shorter useful life. The landscaping, the sidewalks, the parking lots, the stormwater infrastructure, the earthwork, the carpeting, the accessory electrical, the appliance, the movable walls, the overhead doors, the windows, the HVAC, the hot tub sitting out back, the deck I built. I'm really good at building decks. All these things have shorter lifespans, and they're what the government calls 1245. Is that the name of it?
1245 property as opposed to 1250, which is the foundation of the building, the steel beams that are ratcheted into the foundation, the roof sitting on top of it. Even if you don't expect a roof to last 39 years, the government tells you that the roof is going to last 39 years. The way that you expect the sidewalk to last longer than 15. This we're dealing with the government. So what's really going to happen doesn't actually matter. It's just what they tell you. So
So then there's this thing called bonus depreciation, and so a certain percentage of cost in the first year of an asset is put into service is eligible for what we call bonus depreciation. In 2023, it was 80%. In 2024, it is 60%. So 60% of all this 1245, we put a dollar value on all this stuff with a shorter lifespan. What is the amount of accelerated, we call it accelerated depreciation? Mitchell, talk us through this self-storage example, and we'll go through of kind of how this looks in practice of this shorter lifespan policy. Basically, some engineers go through and they put a dollar value on all this stuff. They say, okay, the stormwater is worth this, the HVAC is worth this, the sidewalks are worth this. We have all these dollar figures of this shorter lifespan stuff.
yeah, that's right. So, this is easy when you're um backing up to bonus depreciation in 2001. This is really when this idea hit vogue for taxes. 9/11 happened. There was an immediate like crash in the economy, and it was a big problem, and the uh, Congress and the administration realized at that point in time they could stimulate the economy by just like you said, the government likes people to go build stuff. They like people to build and maintain and operate real estate. And so they said, hey, here's a great way to get people to buy Ford F-150s. We're going to make them bonus depreciable. And furthermore, here's a great way to get people to go build real estate. We're going to make it all bonus depreciable. And so some form of this bonus depreciation, which just means even though it's a bigger asset than $2,500, it's a $50,000 truck, you're going to place it into service and you're going to get some chunk of depreciation right off day one, whether it's 20% or 50% or 100%. And so then in 2017, the Tax Cuts Jobs Act was passed. It brought in a new paradigm of bonus depreciation on used property. You used to have to buy a new truck to get bonus, or you used to have to build a new building to get bonus. And in 2017, they waved a magic wand and you could buy a 1970s storage facility and get another crack at bonus depreciation. And it was at 100%. Now we'll talk about how it's stepped down over time. But still, this new bonus concept now means that, like you mentioned, and we'll get into cost segregation studies, but you start to take components of the building that are shorter life and you get a much, much faster depreciation.
Well, you put a dollar amount on them first. So
You put a dollar amount on them.
you
Yep.
say that window right there is worth 300 bucks.
That sidewalk is worth X dollars a square foot in its
Yep.
current condition.
$7 a square foot for pavement. We have decking and patios that are $20 a square foot.
We
And we
got
assign a
bushes.
value to
Yep.
all these things. And
And
here's an
so
example of a self-storage facility where we bought a property for $1 million. I bought this building, I think it was 2020, 2022. The land value cannot be depreciated. It has an unlimited useful life. So there is no schedule for the land. So you have to put a value on that land. It's very important. Let's say $200,000 in this example. So we had 800K that we spent on this building. The engineers came in, they looked at all the movable doors, they looked at all the overhead doors, they looked at the movable walls, they looked at the pavement, they looked at the bollards, they looked at the landscaping, they looked at the sidewalks, the stormwater, and they said, that stuff is all worth $240,000. So 240,000 of the 800,000 is 5 to 15 year or 1, 2, 4, 5 property, and it can be accelerated, depreciated way quicker on faster schedules. So 240K is our amount that's bonus eligible, of which 60% or 144K in 2024 can be taken as a year one deduction.
back in 2022, it was
Massive.
100%. It was a simpler time. It was a better time, but here we are.
Yeah, we want to talk
These
about
calls were a lot more fun back then, but
no, I mean, this is still
it's
massive.
still a meaningful amount. And in the broad scheme of things, like this is a timing difference. We'll talk about recapture, but like the idea that you can go, so you go buy this property and you take leverage to do it. So you go take, 50%, 60% leverage to go buy a property like this. So it doesn't cost you $1 million in cash to buy $1 million self-storage facility. It's 400,000 of equity to buy this $1 million storage facility. And, the year one, you get you get
$84,000 loss, 8.4% of purchase price. But if you finance half of it, which is a conservative debt amount, you're getting 16.8% of the money you put down in the form of a tax write-off, and you're shielding basically 2 years. You're shielding 2 years of net operating income that's coming in. So this is the main
depreciation
method
along the way. Or,
yeah, year
you'll
2,
get
year 3, year 4, year 5, you'll get even more. So that's actually these numbers are not quite right, but this is how folks, including the ex-president of the United States, soon to be in the election, made all that money back in 2016 and claimed a $700 profit on his taxes. Everybody freaked out. This is exactly how you buy real estate every year. You start to depreciate it. This is what families do to protect their assets.
Yep.
And what they have done for a long time. So this is massive. So we have a couple questions coming in about bonus. At what cost basis or property value does bonus depreciation make sense? And I'm going to use this opportunity to talk a little bit about RE cost seg. I'm not going to sell it a ton. People can use whatever cost seg firm they want, but basically you pay a firm to come in and do this work for you to put values on all this stuff. And these studies cost anywhere from $800 to $8,000 for a $50 million portfolio. And RE cost seg has what's called a rapid report that we sell for $895 that is great for single family homes under $500,000. And, $300,000 house, you might get $20,000, $30,000 of tax deductions for an $895 study. So we can also talk about the offer. Mitchell, are we going to offer people a special deal on some of this stuff for getting in this?
I think we are. I think we're, let's tease it a little, Nick. Let's
give people $500 off their first cost seg.
500 off their first cost seg. All right.
So if you send me an email, nick@sweatystartup.com, I'll introduce you to the team and we'll give you $500 off a cost seg. That includes the rapid report for even one of those $895 reports, commercial building for a commercial building for $2,000. If you email me, nick@sweatystartup.com, I'll intro you to the team and you can get $500 off your first study with RE cost seg. But yeah, basically these things are getting more affordable, and the threshold of which this makes sense is dropping significantly, because if you're going to spend $895 to save $20,000, that's pretty appetizing. But if you're going to spend $3,000 to save $20,000, it's like, well, damn, not quite there.
Yeah. And so what we did in building this product and in building this team and in building this report is we took this market and it was a little old. It was a little sleepy. We kind of re-engineered the way we think about doing this. We started using what's called a virtual site visit, which helped us a lot.
Instead of flying around an engineer who makes $150,000 a year to visit your properties, we do it virtual on a video call, and we can Draw a map
especially,
of your building very efficiently that way.
yeah. So there's other services where you'll call them and say, hey, I have a $1.3 million industrial building, and they'll just hang up the phone on you because it just doesn't make sense. Well, we figured out a way to make it make sense. And like you said, for these smaller, kind of more commoditized housing products, it's data driven, engineer reviewed. But I mean, we've we've created the best bottom of market product there is of these rapid reports. They're killer. So
Yeah, I'm excited about it. So let's talk about the five levers of bonus depreciation, Mitchell. You kind of coined this. Several people have ripped off your Twitter thread and claimed it as their own. But how do we know how much bonus depreciation are we going to get, and how much will I save in taxes if I buy real estate? I think it all kind of comes around these five levers plus a little bonus here.
when the people rip you off, that just means you're doing it right. Hermosi had a good tweet where he was talking about the guy who like invented pockets was just furious when they all like ripped off pockets, and he's like, I thought of pockets. Um, so yeah, there you go. So the five levers of bonus, it really is a great way to think about this to kind of ballpark in your head what you might save. And we'll talk about our calculator in a second. But yeah, the lever one, like you talked about, land versus improvement. In your example, it was 200K of land and 800K of improvement. If that storage facility was on the top of a hill in Big Sur, California, it may not even be worth ever bonusing that thing because, look, you're just not going to get anything. Lever two is the kind of percent of 1245 property. So you were talking about in your example where
Let's
they
talk about the
found,
difference of industrial and storage because that's a
yeah,
pretty vast difference. Like the amount of 1, 2, 4, 5 or
or
shorter lifespan property.
the gas station is the ultimate example of like the dirty secret is the gas station is 100% 1245 property. It's one of these kind of like inexplicable things, but there it is versus, when you are talking about an industrial building that is literally a concrete floor and steel walls and a, couple of industrial lights, there's just no 1245 property versus your storage facilities. They have the movable walls. A lot of times they have the overhead doors. They have just a
A lot of
lot of,
stormwater.
yeah, a lot of grading and stormwater and different outdoor, fencing and stuff like that. So they just come out ahead. Then lever three, like we had talked about before, the percentage of leverage. Back when you could 80% lever apartments and get 30%
You could get
1245 property.
3.5% debt and buy a five
Yeah.
cap, and every dollar you borrow is more money in your pocket every month.
Yeah. And you were putting $1 million down to go buy a $10 million apartment building, and you were getting $2.5 million of bonus depreciation year one, and life was good. Um, and that, so
So
the
as you can
people
use less
who,
bank debt, you get less juice on your money for bonus depreciation.
So seller carry and seller financing is a huge opportunity right now of the people who are doing, creative financing. Like if you can go take over somebody's note and limit the equity you put in a deal, the more leverage you have on a deal and the less equity you have in a deal, you're just gonna, as a matter of, math, get a higher return on your equity with bonus out there.
But it's also way riskier too. It's a double-edged sword.
Oh, a little bit, a little bit. There's a thing about that. And so then, yeah, lever four is your tax rate. If you're already in a 0% tax rate, to get more losses doesn't get you anything. If you're we talk about the best couple out there in real estate is the lawyer, doctor, professional with the real estate pro spouse,
Yeah,
which
we're
will
going to talk about that. That's important.
but if you're in the 40% tax bracket forever because you're an endodontist, and then your spouse is out there getting losses, and every dollar they lose saves you 40 cents, life's good. And then lever five, percentage of bonus allowed. We're in this right now. It's 60%. we had this bill in the House that was going to retroactively take it back to 100 until 2025, and it got shot down last week in the Senate because of I don't know, they killed our beautiful bill. So it was a
It'll be
sad
back.
day.
I have a feeling it'll
It'll
be
be
back.
back. Yeah, I think it will be. This could be cope, but I think it will be back. Just there's a lot of reasons. And then lever six is, what does it cost you to buy the study versus, and I have a seventh lever, which is really just, again, we've said this whole thing's a timing difference. Now, when you can front load bonus depreciation, your time value of money really means something when you get 5% on treasuries.
Yeah, because basically this is a tax-free loan from the government. We're going to talk about interest-free loan from the government. We're going to talk about recapture and what happens when we pay this stuff back. Eventually, we will have to pay this money. Eventually, it's
Yep.
only a matter of time. But we are kicking the can down the road, and if I can save $50,000 of taxes today and pay it 5 years from now, I can put this money in any kind of investment at this moment and get 5% risk-free from an interest rate in treasuries or in a savings account. So pretty high value.
Yep.
Good. We have a couple questions here. JB says, if I get 300K in bonus depreciation in year one, but I only have 150K in income, he says, I am a real estate professional. Does that bonus depreciation amount carry forward into the next tax year?
Yes, it does. But even not to get fully into tax planning, but you want to make, you don't pay tax on the first 150K of income in any kind of meaningful way. Like you pay tax on the $500,000 you earn if you're single, or the 600 if you're married. That's when you
I
get
think
into the
150K earner is still over 30% tax, right?
if you're married, certainly not.
Yeah, that's true. If you have some
uh,
dependents.
yeah. So you get
But the
into
answer to that, to Mitchell,
yeah,
Mitchell's getting in the weeds here. The answer to that is
yeah.
absolutely yes. You can carry it forward. You can carry it backwards. You can go back and cost seg a building you bought in 2021
That's the
or
big opportunity.
2022 or
Yeah.
2023 and get all that bonus depreciation for those first 3 years caught up this year.
You can
So
go all
RE
the way
cost seg
back.
is doing a ton of studies from 2017, 2018, 2019 of people who just did not know to get a cost seg study.
That's a massive opportunity. If you have a high income year and you place some property into service in the past and you never got it done the right way, we can catch you up. And we do that all the time. You file this form and yeehaw, you're ready to
Email me,
go.
nick@sweatystartup.com. We'll give you 500, or actually, yeah, $500 off any study. So I'll see if I can get that done for you. Let's talk a little bit about short-term rentals and how this
Yeah,
workaround is. I guess first we need to talk about RE Pro status. Let me share this screen here. You can give us a little bit of info on what it means to be a real estate professional.
sure. So the big opportunity with real estate professional is you get to deduct real estate losses against your ordinary income. So we talked about this endodontist who goes to work and works 100 hours a week or whatever, and their spouse, if they were making $1 million a year, but they're working 80 hours a week and that's their full-time job, and they handed you, Nick Huber, $100,000 to go buy storage facilities and got a K1 back with depreciation losses out there, they don't get to take the losses. In 1986, the government figured out that all these hedge fund guys were going and buying buildings and ginning up a ton of losses and paying no income tax on their income. And so they did this like major tax reform to separate passive losses from active income. So passive income, you pay tax on it. Active income, you pay tax on it. Active losses, you get as a deduction out there. Passive losses, you can only set off with passive income.
Let me try to explain this as simply as possible. And I know there's more than two types of income, but let's break it
Sure.
into two buckets. There's active income that's from my primary activity, whether it's my W-2 job or my number one business. And then there's secondary side hustle income, passive income from investments, from stocks, from buying things that I actually don't have any material participation in. And those cannot offset each other. So if you make $150,000 a year at your W-2 and your W-2 is not real estate, and you buy a building for $1 million and you get $150,000 of deduction, that passive loss cannot offset that active income. Is that a
And
fair way
real
to say this?
estate, yes. And the IRS has gone a step further to basically say real estate income by its nature is passive. Like if you're getting paid rent on a building, that is passive income and it generates passive losses. So the only way to be able to deduct those passive losses against your ordinary income is to become a real estate pro. And to become a real estate pro, you have to meet these two thresholds. You have to spend 750 hours in real estate, and it has to be more than half your time. So there was an IRS court case, there was a tax court case a couple of weeks ago where it was like a lawyer or something said he was also a real estate pro. He had a full-time job, but he's also a real estate pro. And the IRS just was like, no, you can't have a full-time job and be a real estate pro. It's impossible. You don't work 80 hours a week. We don't believe you. So
Okay, so then there's a loophole around this, which is marriage. And you alluded to it earlier. That is, if a high W-2 income earner in small business and entrepreneurship and consulting as a doctor, whatever, marries somebody who is a real estate professional, then jointly they both qualify as real estate professionals.
that's right. So that's
Powerful.
a beautiful thing. So and yeah, that basically the other big opportunity with real estate pro is if you are, we talk about these qualifying industries, development, redevelopment, construction, reconstruction, acquisition, conversion, operation, management, leasing, brokerage, owning and renting.
All these different assets that kind of bleed into the real estate industry.
So the big one is if you're in construction, you're a real estate pro. Or if you're in real estate property management and you own the company you work for, you're a real estate pro. So those are huge opportunities where if you're in real estate construction, you got to be.
You must own at least 5% of the company though. So like if you're an acquisitions guy for a real estate shop, but you have no equity or no promote, then it's harder to make that case.
That's tough. Yep. So
good deal. Let's talk about recapture. Eventually what goes up must come down, or what's the word here?
what goes down must come back up, unfortunately. So yeah, if this is great. You buy $1 million property, you get 300 grand of bonus depreciation year one, you save 100 grand of tax, and then you go buy a jet ski. And then you have a rough few years in the market and you go sell that property at, break even, or you go sell it for 1.2, you crushed it, right? Well, you're going to pay taxes on that 200 grand of gain you got. You're going to pay capital gains tax 20%. So you're going to owe 40 grand, but that 100K that you got to deduct and go buy the jet skis with 3 years ago, well, the jet skis gone, right? It floated out to sea or whatever. And you still owe that 100K. So you need to be understanding that this is a timing difference. This is a deferred tax liability. You are borrowing money from the government interest-free.
There's actually some situations where people have to sell buildings at distress and just pay the note off. They're not getting actually any cash, but their basis has been depreciated down below what they sell an asset for, and they actually have a tax bill at the time of closing because they took a ton of bonus depreciation at the beginning. Life was great. The deal went wrong. They had to sell the asset at a loss. Even though they sold it at a loss, it was still a taxable gain because of all the depreciation they took. I'm gonna explain this as simply as possible so people get it. Buy $1 million building, depreciate 250K. You have 750K of basis left. Sell it for 1.5. You have 750K of total tax, 500K at capital gains, 250 at recapture. That's what this is showing. So you're gonna have tax that comes back when you sell an asset. This bonus depreciation doesn't last forever, so it really matters how long you plan to hold a building. People call RE cost seg and call Mitchell all the time, say, should I do a cost seg on this building? And your first question is always, how long do you plan to hold it? If you plan to hold it for more than 3 years, it generally makes sense because you can defer a lot of taxes in 3 years and put that money to work. But if you're trying to flip this thing and sell it next year, It very rarely
Yep.
makes sense. Strip mall guy, uh, Don Tepman very rarely does cost segs because every deal he does, he's trying to buy, fix, and sell. And he sells it within 24 months, so he does not do cost segs. I think
Yeah.
that's a shame. I think real estate is really powerful with time, but there are a lot of business models that sell quickly. If you're in one of those business models, you can make a ton of money, but this is not for you.
Yeah. And so also, I mean, there are some ways through recapture. You can 1031. Opportunity zones do really well with recapture because they get that step up in basis, at the end of 10 years. So there are some ways to mitigate recapture. Also, there's just ways to mitigate recapture in the sense of if you're walking into a bunch of recapture, we've advised some people about effectively doing a cost seg on the way out, a purchase price allocation to uh, make sure that you're valuing the recapture assets properly. But that's mostly for really, really big deals out there.
So
So
Mitchell,
then
I'm going to confirm this with you before I answer it. Does this tax rule, do these tax rules apply to Canadians who invest in US real estate? My thought would be that it does impact the US tax return that a Canadian files, but it does not impact the tax you owe the Canadian government.
that the
And there's
U.S.
nuance around this as
Yeah,
well.
yeah. So the U.S. real estate would be subject to U.S. taxes, and this would matter for that. But definitely, if anyone says, "Do you cost seg properties in Canada?" The answer is no. Do you cost seg properties in the U.S.? The answer is yes. And so like you got to go talk to your accountant about your particular circumstance, especially when we go cross border, of whether this would be really helpful and very impactful or not impactful at all.
So
I
let's talk
don't
about
know.
1031 next because I think there is a creative way to get around what we call recapture.
Yeah.
Um, what is a 1031 exchange? Or I guess I'll explain what a 1031 exchange is and you kind of correct and elaborate. So if you're going to sell an asset for a gain or a loss, and the government offers this portion of the tax code called a like kind exchange, a 1031 exchange, that allows you to basically take your basis in one asset and buy another one, or you can do a reverse 1031 exchange and buy another asset before and sell that after. But basically, you're keeping your basis and transferring it across properties and not paying the tax. So let's say I buy a building for $1 million, I hold it for more than a year, sell it for 1.5. I can then take a certain time period. I can go through the rules of 1031 exchanges. I can find another building that has a higher cost. So you have to up your basis, and I can go into that building and exchange it. And there's no tax event there, basically. It's like me selling Apple stock at a gain and buying Google stock and my basis transferring over. That's kind of the essential how it works in real estate.
That's right. And so, yeah, you have to replace, you have time constraints. You have 45 days to identify and 180 days to close. You have to use a qualified intermediary to hold the money, meaning you can't take dollars back into your bank account. They got to go into a lawyer's office or a
Mm-hmm.
QI's office. um, you have to replace all the 1245 property. So you can't sell an apartment building and go buy land because you're
Mm-hmm.
not replacing the property. And you have to, in effect, buy a more expensive property, or every dollar that you don't replace gets taxed immediately.
Mm-hmm.
So you get to preserve your basis at the bottom and carry over your basis, but you have to really go buy something more expensive than what you're selling.
Yep. So step up in basis, I'll explain that one briefly here. So if I become an old man and die, or if I get hit by a bus tomorrow,
That won't happen.
and
We
my
know that.
real estate passes on to my children, the first about $20 million of it gets a step up in basis. They can cost seg it again. They can get a ton of deductions and go on with their life. It seems too good to be true. Dying just seems too good to be true when it comes to real estate.
Yeah, you had to pay the ultimate price, but yeah. So today the estate exemption out there is about $15 million for a single person, 30 some odd
30
for
for
a
a
married
couple. So
for a
if I'm still
married
married,
couple.
if I'm lucky enough to still be married when I die, the first $30 million of real estate can be passed on to my heirs tax free.
That's a big thing that's stepping down at the end of next year. So a lot of folks with high incomes are doing estate planning today and starting to.
Because that number is scheduled to drop. I have a feeling
scheduled to
that'll
drop
change
down
too.
to 12, Yeah, I mean, a lot's going to happen with this. Just go
People are
out
going to
there
try to
and
die
vote.
faster here to get that done.
There was when George Steinbrenner died, it was one of these times where there was some weird tax loophole where there was literally no estate tax. So George Steinbrenner died and didn't pay estate tax.
He timed
Um,
it perfectly to hand his billions to his kids.
that's it. That's it. And so but basically when you die, all your estates get marked up, all your assets get marked up to fair market value, pass through your estate, come out, stepped up in basis, handed to your kids at fair market value at the date of death or 6 months thereafter. And if you die with less than 30 million of assets, if you're married today, you don't pay any estate tax. So,
Good
um,
rule. I don't think the government should tax people all their lives and then tax them again to hand it off to their kids.
oh my gosh, that's a terrible thing to say, Nick. I disavow. Okay.
So opportunity zones. Todd also mentioned this in the comments.
Yeah.
These are areas and regions where the government has stipulated like areas of economic stimulation, or you're going to get tax breaks if you go to these certain areas where they're up and coming areas. Maybe there's some poverty in these neighborhoods, high in unemployment. They've designated some areas that are called opportunity zones to encourage investment from real estate investors. And if you buy a building in these opportunity zones or land in these opportunity zones and you spend a certain amount, is it 25 or 50% of the original basis in improvements, you're going to make this building better, and then you hold it for 10 years, you have basically a get out of jail free card with capital gains. And you can take capital gains from building sales, from business sales, from stock sales, and you can put them in opportunity funds, and you can go and buy these assets in opportunity zones, do these improvements, and you can end up after 10 years with no taxes. I think this program was massive and had a lot of great potential. Was that part of the Tax Cuts Jobs Act of 2017 as well?
Yeah, that's right. Yeah, this all came out of
I don't know a ton of people that actually do opportunity zone investment. So
yeah.
I don't think it's been as stimulating as the government hoped. Maybe it's because they made people jump through a lot of hoops and also wait 10 years.
Right. There's not that many patient folks in real estate. So, there's a lot of people who have built great little businesses out of opportunity zones, but yeah, there's a lot to do. So this is where you would take any appreciated capital gain asset. You mentioned Apple stock earlier. You can take a stock, you can take another property, you can take the gain and invest the gain into an opportunity zone. You have to hold it in there for 10 years. And then, yeah, everything after 10 years gets stepped up out of the deal. There's another thing where I think if you hold it like 40 years, it just gets, or maybe like 20 something years, it just gets stepped up anyway at like 2043 or somewhere weird. But yeah, I mean, they're a high hassle deal. You have to know what you're doing, especially if you're going to sponsor a deal in an opportunity zone and represent that it's your job to make sure that all the compliance is handled well.
Mhm.
Call a lawyer, call a CPA,
Yep.
have experts on your team. Yeah.
Mitchell, let's go through the STR loophole. I'm going to explain this in 30 seconds, basically. These short-term rentals, Airbnbs, they can actually count as a business and not real estate in the eyes of the government. So you don't have to be a real estate professional if you meet certain criteria with short-term rental management, which is your average rental is less than 7 days, you spend less than 2 weeks in a year there, and you materially participate more than anyone else, or 500 hours or 100 plus hours. So if you meet these criteria, then a short-term rental can actually offset active income. Your
That-
depreciation from these buildings can offset active income.
That's right. So I'm a CPA. I own a CPA firm. We have 20 people working for us. If we buy a building in Houston, Texas, and occupy the building on our own,
Owner occupied is a great point.
yeah, we can go in and deduct the depreciation against the income generated by the business. That
Without being a real estate professional.
without being a real estate professional. That's right. It's like lift. It's like any other piece of business equipment that you would use to and an accessory to operate the business. And
Yep.
so the STR loophole kind of legs off of that concept in the sense that if you average 7 days or less, or 30 days or less and provide substantial service, you're like running a hotel. You're not running a rental business. And so, you could go arbitrage Airbnb. People used to do that back when Airbnb existed. And like, they would go rent an apartment and then go sub rent it for 7 days and pay the flat monthly rent and try to make a spread in the middle. Where you're doing the same thing with that, you just happen to own the property. So the IRS just looks at this as there's a business, and the business has real estate to support the business,
Yep.
and the business
It's a core function of the business.
is a boutique hotel. And so if you rent an STR and you don't bonus depreciate your property, you are insane. Is my
Yep.
That's what I tell people.
And if you plan to hold it for more than a couple of years. Yep.
Yeah.
Okay, so 45L is a energy efficiency code where if you're a multifamily or any kind of developer of any kind and you build buildings that reach a certain energy code, you can get a $2,000 credit per door back to you. Is that about right, Mitchell? I don't want to spend too much time on this. I want to get to a couple cute questions, but
Yeah. I mean, it's from 500 to 5,000 per unit. It's
Mhm.
one of these things that's getting all goofy. They released a bunch of new regulations I think it was in the Inflation Reduction Act. And
So
same,
we have a great question. I don't want to interrupt, but we're almost out of time. So
yeah,
I've never taken bonus depreciation on the commercial properties I own. They were purchased starting in 2019. If I want to go back to 2019 and get all this bonus depreciation, does it require filing 4 years of amended tax returns? I think the answer to that is no. You file one form and then you
yeah,
get to pull all that depreciation to this year's tax return and next year's tax return and the tax return after that. And it can be massive. You can amend them if you want to go back and get these taxes back, get refunds, but
and this guy's
I guess it depends, right?
it depends. And this guy's saying, oh, and reissue K1s and then file amended personal returns. Like he doesn't, he or she doesn't seem to want to do that. But yeah, especially if you have 15 partners, no
Yeah.
partner wants to get 3 amended
So what's
K1s.
the form you fill out to kind of catch up that depreciation?
So the only reason why you would do that is if in 2022 I had the biggest gain of my life and I realized that I dropped the ball, so to speak,
Yeah,
spilt the
really
ice
high
cream on
tax
the
rate.
ground. You can get a mulligan, but this year or for just to do this efficiently and succinctly, you can file a form 3115, which basically just it has to be filed timely. So you do it for 2023 if you haven't filed, or you do it next year, and you basically just catch up to say, what if I did cost seg and bonus depreciate everything the right way? I should have done it in the first time. And what it does is takes all the depreciation you've taken thus far.
Man, that's going to be
eh,
massive. You get 2019 100% bonus. You get 2020, 2021, 2022, and 2023. So you get 4 extra years of depreciation.
Yeah.
I'm
Eh,
drooling over this.
Yeah, the trick is that you've already been depreciating for 5 years. So if it were 40-year property, you did 5 divided by 40,
Yep.
you've done an eighth of it, but an
That's
eighth,
10%. Yeah, 12% of it right there.
the eighth is 12%, but you think you're going to go get 30. So then the difference is what's it going to cost you? And you're going to go capture 30 to
Well, anonymous
35%.
attendee, we would love to give you $500 off a cost seg, and we are the cheapest in the business and the best in the business. So email me, nick@sweatystartup.com, and I will make an intro to the team over there, and they'll be able to they'll give you a free proposal. Hey, here's your building. Here's what you paid. Here's what we think we can get you in terms of depreciation. So
Yeah,
we'd
they
love a
tell
chance to earn your
you,
business there.
speed, quality, price, you have to pick two of the three. I really think we get three of the three here. I don't know.
Nick@sweatystartup.com.
Beautiful.
$500 off your first study and the best prices around. I'll make an intro directly to my contact at Ari Koseg, whom I trust. Nick
Love
at
it.
sweatystartup.com. $500 off any study. Aaron Smith says, thank you both for this. Anybody else have anything that they want to say to Mitchell and Nick? We are reading this Q&A right now.
Thank you,
Bring it
Aaron.
at us. Bring it at us. No,
Well,
seriously, Mitchell, this is super valuable. I know you charge what do you charge now? Almost $1,000 an hour for some consulting that you do. So for you to come here
I
and spend
turned
an hour
off the
with us is
consulting link. You can't even get at me except for
so
the
there.
webinar.
It's you cannot even put a price on Mitchell Baldridge
It's
here. So
priceless. I'm 30 years old.
oh,
I
cool,
have a
fun one.
million bucks. I'll earn $1 million this year. Where to start?
Congratulations, Hunter, on a great business. He says,
Yeah,
I'm
have
30 years
fun staying
old.
rich.
I have about $1 million liquid, and I'm going to earn about 1 million income before taxes this year. Um, it's awesome. Congratulations, Hunter. I mean, is now a great time to go in and start buying a bunch of real estate? That's debatable. Definitely not no-brainer yield like there was in 2021, and that's why transaction volume is really slow. But being liquid right now is a great situation, man. So congratulations. If you want to get into real estate, if you want to invest in real estate, I think that you should either take it very seriously yourself or find somebody really reputable to invest with and get a lot of advice around that. But yeah, you're in a good situation. Um,
Find a
we,
deal.
we have another question. We have another question here. Husband's a W-2 professional, wife's a stay-at-home mom of two. How can I use the wife's status to save tax money? Well, she can do the work to become a real estate professional. She can get her real estate license. She can start transacting homes. She can spend more than 500 hours and make it her number one thing that she does, which
Excuse
is
me.
real estate.
Looking to buy rental condos. Yeah, if they're
Yep.
long-term rentals, she's going to have to spend 750 hours and more than half her time doing real estate. It sounds like more than half her time is taken care of.
Mhm.
750 hours, you're going to need to, you'll spend time buying them, you'll spend time setting up, but you'll need to own 3 or 4 of these and self-manage them and all that in the long run to maintain that status. But
Look
I,
for a CPA who's open to helping you build the case. I mean, look, there's CPAs
yeah,
that turn you down and say it's not worth the effort, and there's CPAs that say, hey, here's what we need to do. Let's do the work to make this happen. Find
yep,
CPAs that are willing to work with you.
yeah.
Do I
Getting
have a guide on
started.
getting started in short-term rentals? No, I don't have a guide on that. It's hard. Airbnbs are getting crushed lately. Be really careful out there. That's what I'll tell you.
It's a very hard time to start. I mean, there was this huge boon in vacationing after COVID that has slumped down a little bit. And if we hit a rocky economy in the next couple of years, it'll slow down even more.
Yep.
That's a hard business.
Awesome. I think, okay, cool. We got a win here. Thank you much. Thank you both. I have a great understanding of depreciation and how this all works. So, are there limits to retroactive depreciation? Last question, Mitchell, before we log off here. Are there limits to retroactive depreciation? Can I do it
Um,
2 years from now? How far can I go back if I do this later in the future?
there's no limit. There is one limit, which is excess business loss rules. You can't use losses from real estate to you can only use so much loss from real estate to go offset losses in your W-2 or in your business that are unrelated. It's about $600,000. So like, and that came out, I think last year or maybe in 22. I think it was when bonus started stepping down. It came about like there was a hedge fund guy who called me who had made $8 million in New York and put like $6 million into car washes, thinking he was going to get the whole loss, and then realized he was limited to 300 grand because he was a single guy, and it was just a
Get some good
total
advice.
disaster.
That is a
Yeah.
disaster.
So
Goodness
yeah,
gracious.
the
Hopefully
begin
had
with the end
enough
in
cash
mind.
left over. Hopefully had enough cash left over to pay his taxes.
Yeah, I think he'll land on his feet. But but like, yeah, it just is like, you know what? Begin with the end in mind, or play the whole thing through, all the way from you're running a tax strategy. If tax is a huge part of the alpha that you're going to generate and doing what you're going to do, make sure the tax thing's going to work, and then figure out what's going to happen all the way at the end when you dispose of the investment. So that's the only way to reliably predict tax alpha, is to get really, really good help along the way.
Yep.
So
Mitchell, you're a badass. I appreciate you being in my corner.
same here,
Thanks
man.
for being a great partner at Ari Koseg. And thanks for 45 minutes, man. It's been great. And we will see you all next time.
This is a good one. So we'll ship this out later this week.
Yep. If you applied, we'll get you the recording in a few days.
See
Peace,
ya.
everybody.